Let's see if we can do it here. Ooh, I don't like that. Let's make it a little, that's better. All right, using a correctly labeled aggregate supply and aggregate demand graph, show the impact of a sudden large decrease in private investment spending. So just a regular, maybe I made that too big. Anyway, here we are at, let's say we're at equilibrium. And then we're going to have a sudden decrease in private investment. So at a C plus I plus G plus XN, which is aggregate demand, investment goes down, which implies aggregate demand has to go down. Leftward shift of aggregate demand, let's just do that. PL1, Y1, YF. We can see that output has gone down. We can also see that the price level has gone down. We'll call that PL. All right, output goes down, price level goes down. Using the results in Part A, explain how employment is affected. So, affected. Anytime you see employment, I freeze like a cat because I'm so used to saying unemployment. But obviously, if output goes down, employment would decrease. So, easy enough. C, identify one specific fiscal policy that might be implemented to offset the effects of a decrease in investment. So fiscal policy is either government spending or taxes. We are in a recession, so we need more. They don't ask me to do long-run aggregate supply. Notice they don't ask long-run aggregate supply curve. So actually we could get rid of long run. We don't really need to show that full employment area. Oops. There we go. All right, so let's call that YF anyway. Government spending would need to go up. We need to shift aggregate demand back to the right. So to do that, we want government spending to go up or taxes to go down. Explain how the policy would affect each of the following in the short run. So aggregate demand would go up, output would go up, price level would go up. Real interest rate. Anytime the government is spending, the real interest rate is going up. And you're going to say, Charles, how do you know that? Well, anytime the government is spending, we're going to do a loanable funds graph to show that. Anytime the government is spending, they have to be borrowing. Anytime the government is spending, they're borrowing. This is really the crowding out effect. If the government is borrowing, they're borrowing from the banks. This is the loanable funds. The loanable funds is just money in the bank. So if the government is borrowing, they've got to be taking it out of the bank. So supply of loanable funds would decrease. When supply of loanable funds decreases, the interest rate goes up. Obviously, real interest rate on the vertical, that's why I did loanable funds, right? Quantity of loanable funds on the horizontal. So real interest rates are going to go up here. Understand that when those real interest rates go up, because the government is spending, private investors are crowded out of the market. So investment would go down just a little bit. But not enough to offset that big increase in government spending. So, and they even asked that, obviously. We just need to know real interest rates would go up. All right, identify an open market operation that the central bank, the Fed, might implement to offset the effects of that decrease in investment. Explain how the policy would affect. So the way we understand this is the Fed would buy bonds. That's going to increase the money supply. That's going to make nominal interest rates go down. That's going to make investment go back up, make aggregate demand go up, price level go up, real GDP go up. Output, obviously, goes up, but unemployment would go down. So this is an expansionary monetary policy. If nominal rates are going down, tricky. If nominal interest rates are going down, we tend to say that the real interest rate is going down. There's two ways that if we had to explain real interest rates, we always want to use nominal, right? If nominal's going down, real's going down. and the price level. If the price level's going up, the real interest rate's going down also. Aggregate demand would obviously increase. Output and price level would both increase also. As we can see, price level, output increased also. Aggregate demand obviously increased also. Easy enough. If the central bank continues the open market operation, explain the long-run effect of each of the following. Well, obviously, if the price level's going up, we're going to have more and more inflation. The value of the domestic currency in the foreign markets. Well, if the prices of our goods and services are going up, do you think people want to buy more of them or less of them? So let's say it's between the U.S. and Japan here. If our prices are going up, think about this. Japan prices look relatively cheaper. So if their goods look relatively cheaper, U.S. citizens are going to dump their dollars into the FOREX, and they're going to buy Japanese yen to pay for those relatively cheaper goods that the U.S. would import. So we can do this two ways. We tend to want to talk about, I'm going to erase that because I need that space. There we go. I know the price level goes up. All right. We know that as U.S. citizens dump their dollars into the FOREX, the supply of dollars would increase. As the supply of dollars increases, the value of the dollar would go down. And that's what we're talking about. They're talking about explaining the long run, the value of the domestic currency. Let's just assume this is our currency with the higher price level. Our citizens want to buy cheaper goods. They dump their currency into the FOREX. The supply of dollars, let's just use quantity of dollars on the horizontal, dollars on the top. And it would be yen to dollars if we had to do it here. At the same time that our currency is depreciating, we know that when those same U.S. citizens need to buy yen to buy those relatively cheaper goods, the demand for yen is increasing. Therefore, the value of the yen is increasing also. And this would be yen on the vertical, quantity of yen on the horizontal, and dollars to yen. All right, guys, I think that's it. The value of our currency was obviously depreciating. Okay, be safe. Bye.